Hey everyone, welcome back again to our CA Foundation Business Economics series where we are discussing business economic concepts in the most quick and practical manner. So, without wasting much time, let's get back to the video. So, today we will be covering the additional part covered in the Institute study material, which is glossary. So, here is the first definition economics. So, what is economics? It is the branch of knowledge which is concerned with production, consumption, and transfer of wealth. Then comes second one, business economics. So, the use of economic analysis to make business decisions involving the best use of an organization's scarce resource. So, scarce means a limited resource. Then comes a third one, microeconomics. So it is basically the study of behavior of different individuals and organizations within an economic system. Here the focus is on small number of group of units rather than all the units combined. Similarly, the fourth one, macroeconomics. So it is a study of the overall economic phenomena of the economy as a whole rather than its individual parts. Accordingly, in macroeconomics, we study the behavior of the large economic aggregates. Then comes positive economics. So it is a branch of economics that concerns the description and explanation of economic phenomena. It focuses on facts and cause and effect relationships. Then normative economics. So it is that part of economics that expresses value judgments about economic fairness or what the outcome of the economy or goals of public policy ought to be. Then comes economic systems. So, an economic system refers to the sum total of arrangements for the production and distribution of goods and service in a society. It includes various individuals and economic systems. Then comes capitalist economy. So, it is an economic system in which all the means of productions are owned and controlled by private individuals for profit. Then comes socialist economy. So, an economic system where the resources are allocated according to the commands of a central planning authority and market forces have no role to play in the allocation of resources. Then comes mixed economy. So, an economic system which depends on both market and government for allocation of resources. The aim is to include the best feature of both capitalist and socialist economy. So India is a mixed economy. Then comes demand. So the various quantities of a given commodity or service which the consumers would buy in one market during a given period of time at various prices or at various income levels or at various price of related goods is known as demand. Then comes 12th one, market demand. So it is defined as the sum of individual demands for a product at a price per unit of time. Then come elasticity of demand. So it is defined as the responsiveness of the quantity demanded of a good to change in one of the variables on which the demand depends. So more precisely, elasticity of demand is the percentage change in quantity demanded divided by the percentage change in one of the variable on which the demand is depends. Then comes inferior goods. So inferior goods are those goods whose quantity demanded decreases with the increase in money income. Then comes price elasticity. So it is expressed as the response of quantity demanded of a good to a change in its price given the consumer's income, his taste and price of all other goods. Then comes 16th one, income elasticity. So it is the degree of responsiveness of quantity demanded of a good to change in the income of consumers. Then comes cross demand. So it refers to the quantities of a commodity or service which will be purchased with reference to change in price not of that particular commodity but of other interrelated commodities, other things remaining the same. Then comes cross elasticity. So a change in the demand of one good in response to a change in the price of another good represent cross elasticity of demand of the former goods for the latter goods. Then comes 19th one, advertisement elasticity. So advertisement elasticity of sales or promotional elasticity of demand is the responsiveness of a goods demand to change in firm spending or advertising. The advertising elasticity of demand measures the percentage change in demand that occurs given a 1% change in advertisement expenditure. So what impact the demand will create based on the advertisement spending we does or we may do. Then comes producers goods. So producers goods are those goods which are used for the production of other goods, either consumer goods or producer goods themselves. Then comes consumer goods. So these goods are used for final consumption. Then utility. So utility is the anticipated satisfaction by the consumer, and satisfaction is the actual satisfaction derived. Total utility. So total utility is the sum of utility derived from different units of commodity consumed by a consumer. Then comes marginal utility. So it is the addition made to total utility by the consumption of an additional unit of a commodity. Then comes 25th one, consumer surplus. So it is defined as the excess of price that the consumer is ready to pay for which from which he actually pays. Then comes indifference curve. So it is a curve which represents all those combination of two goods which gives same satisfaction to the consumer. Then comes indifference map. So a collection of many indifference curve where each curve represents a certain level of satisfaction. In short, a set of indifference curve is called an indifference map. Then comes 28th one, supply. So it refers to the amount of a good or service that the producers are willing and able to offer to the market at various prices during a given period of time. Then comes elasticity of supply. So it is defined as the responsiveness of the quantity supplied of a good to a change in its price. Then comes equilibrium price. So the price at which the wishes of both buyer as well as sellers are satisfied. At this price, the amount of the that buyer wants to buy and seller wants to sell are equal. Then comes production. So it is the organized activity of transforming resources into finished products in the form of goods and services. Then comes land. So the term land is used in a specific sense in economics. It doesn't mean soil or surface alone, but it refers to all free gifts of nature. Then comes labor. So the term labor means any mental or physical exertion directed to produce goods and services. Then comes capital. So it is that part of wealth of an individual which is used for further production of wealth. Capital is the stock concept which yields a periodic income which is a flow concept. Then comes entrepreneur. So a factor which mobilizes all other factors of production like land, labor, capital and combines them in the right proportion, initiates the process of productions and bears the risk involved in it. Then comes 36th one, average product. So average product is the total product per unit of the variable factor. Then comes marginal product. So it is the change in total product per unit change in the quantity of variable factor. Then number 38, isocont. So an isocont represents all those combination of inputs which are capable of producing the same level of output. Then cost analysis. So the study of behavior of cost in relation to one or more production criteria, namely size of the output, scale of operations, prices of the factor of production, and other relevant economic variables. Then comes accounting cost. So accounting cost relate to those costs which involves cash payment to by the entrepreneur of the firm. They are explicit cost and are the expenses already incurred by the firm. Then economic cost. So the cost which takes into account the explicit as well as implicit cost is known as economic cost. Then social cost. So social cost refers to the total cost borne by the society on account of a business activity, and it includes private cost and external cost. Then comes fixed cost. So the cost which does not vary with the level of output up to a certain level of activity are known as fixed cost. Then variable cost. So these costs are a function of output and hence vary with the production. So different production level may have different variable cost. Then comes marginal cost. So marginal cost is the additional addition made to the total cost by production of an additional unit of output. Then number 46, market. So a market is a collection of buyers and sellers with the potential to trade. The actual or a potential interaction of the buyer and seller determines the price of a goods and services. Then comes perfect competition. So it is a type of market which is characterized by many sellers selling identical products to many buyers. Then monopoly. So it is a situation where there is a single seller and many buyers. So the product sold does not have any close substitutes. Then monopolistic competition. So this type of market is characterized by many sellers selling differentiated products to many buyers. Then number 50, oligopoly. So there are a few sellers selling competing products to many buyers. Then average revenue. So it is the revenue earned per unit of output. It is nothing but the price of one unit of output. Then comes number 52, marginal revenue. So it is the change in total revenue resulting from the sale of an additional unit of the commodity. Then price discrimination. So it is a method of pricing adopted by a monopolist to earn abnormal profits. So it refers to a practice of charging different prices for different units of the same commodity. Then comes cartel. So cartel refers to a group of firms that explicitly agree to coordinate their activities. Then comes number 55, business cycle. So the rhythmic fluctuations in aggregate economic activities that an economy experiences over a period of time are called business cycles or trade cycles. A typical business cycle has four distinct phases, namely expansion, boom, contraction, and trough. Then comes absolute advantage. So the advantage of greater efficiency that one nation may have over another or others to produce a good or service using a special fewer resources, considered as basis for international trade by Adam Smith. Then comes ad valorem tariff. So tariff expressed as a constant percentage of the monetary value of one unit of the value of the imported goods. Then comes administered interest rates. So deposits and lending rates are not market determined, they are prescribed by the central bank. Number 59, adverse selection. Opportunism characterized by an informed persons benefiting from trading or otherwise contracting with the less informed person who does not know about an unobserved characteristics of the informed person. Example, a disproportionately large share of unhealthy people tends to buy insurance policy. Number 60, aggregate demand. So the total demand for goods and service in an economy which is equal to the total spending on goods and service. There are four components of aggregate demand that are consumption, investment, government spending, and net exports, that is X minus M. Then comes agreement on subsidies and countervailing measures. So, a WTO agreement that aims to clarify definitions of subsidies, strengthen disciplines by subsidy type, and to strengthen and clarify process for adopting countervailing tariffs. Then comes agreement on technical barriers to trade (TBT). So a WTO agreement that aims to prevent the standards and conformity assessment systems from becoming unnecessary trade barriers by securing their transparency and harmonism with international standards. Then comes agreement on textiles and clothing. So a WTO agreement which replaced the multi-fiber agreement MFA provides that textile trade should be deregulated by gradually integrating it into GATT disciplines over a 10 years transition period. Then comes number 64, agreement on trade related investment measures TRIMS. So a WTO agreement that expands disciplines governing investment measures in relation to a cross border investment. Then comes allocation function. So government role to ensure optimal or efficient allocation of scarce resource to correct the sources of inefficiency in the economic system. Then comes number 66, American currency quotations. So indirect quotation showing the number of units of a foreign currency exchangeable for 1 unit of local currency. Example, $0.0151 per rupee. Then comes anti-dumping duties. So additional import duties so as to offset the foreign firms' unfair trade price advantage. Then comes antitrust laws, so also referred to as competition laws. It regulates the conduct and organization of business corporations generally to promote fair competition for the benefit of consumers. Then comes arbitrage. So the purchase of a good of a currency or good where it is lower price for immediate resale in a market where it is higher price in order to make a profit. So a simple example is, suppose I have a good which in one market is priced at 100 rupees and I saw it is sold in another market is 200 rupees. So I can make the arbitrage profit by buying from one and selling it to another. Then comes number 70, asymmetric information. So a situation where one party to an economic transaction possesses greater material knowledge than the other party. Then comes number 71, autonomous consumption spending. So the part of consumption spending that is independent of income, also the vertical intercept of the consumption function. Then comes number 72, balance of payments. So a summary statement of all the international transactions of a residents of a nation with the rest of the world during a particular period of time, usually a year. Then comes number 73, bank rate. So the standard rate at which the RBI, that is Reserve Bank of India, is prepared to buy or rediscount bills of exchange or other commercial papers eligible for purchase under the RBI Act. Then comes number 74, base money. See also reserve money. 75, bilateral agreements. So agreements between two nations regarding quantities and terms of specific trade transactions. Then comes number 76, bond. So it's a debt investment in which a investor lends money to an entity, could be corporate or governmental, which borrows the fund for the purpose of raising capital for a defined period of time at a variable or a fixed interest rate. Then comes bound tariff. So it's a tariff which a WTO member binds itself with a legal commitment not to raise or above a certain level. Then comes Bretton Woods institutions. So they are the World Bank and the IMF, that is International Monetary Fund. Then brownfield investments. So the purchase or lease of an existing production facility in order to use it for a new activity. Then comes number 80, budget deficit. So the amount by which spending exceeds the income of an entity over a particular period of time. Then comes budget surplus. So it's the amount by which income exceeds the spending of an entity over a particular period of time. Then comes number 82, Cambridge approach. So the neoclassical approach or cash balance approach to quantity theory of money put forth by Cambridge economists. Then comes number 83, capital consumption. So it's a depreciation of a fixed asset. After that, number 84, capital intensive commodity. So the commodity with the higher level ratio at all relative factor prices. Then comes 85, cash reserve ratio CRR. So the fraction of the total net demand and time liabilities of a scheduled commercial bank in India which it should maintain as cash deposit with the RBI irrespective of its financial or size or financial position. Then comes circular flow of income. So the continuous interlinking of phases in production, income generation and expenditure involving all the different sectors of economy, a simple model that shows how goods, resources and money payments flow between households as well as the firms. A circular diagram, you can check it on the internet. Then comes number 87, club goods. So impure public goods which are replicable and therefore individuals who are excluded from one facility may get similar service from an equivalent provider. Then comes common market. So a free trade area with no barriers on trade among members on harmonized trade policies towards the rest of the world and also allow the free movement of labor and capital among member nations. Example, the European Union, EU. Then comes number 89, common resource. So a non-excludable and rival goods generally available free of charge. Then comes number 90, comparative advantage. So the advantage conferred on an individual or country in producing a good or service if the opportunity cost of producing the goods or service is lower for that individual or country than for another producers. Then comes number 91, compensatory spending. So government spending carried out with the obvious intention to compensate deficiency in private investment. Then comes number 92, compound tariffs. So a combination of an ad valorem and a specific tariff. Then comes number 93, consumer price index, CPI. You may have heard it many times in the news. So it measures changes in the price level of market basket of consumer goods and service generally purchased by households, constructed using the prices of a sample of representative items whose prices are collected periodically or at a specific terms. Then comes consumer surplus. So it's the difference between what consumers are willing to pay for a specific amount of commodity and what they actually price. I think it's repeated. Then comes number 95, consumer function. Functional relationship between aggregate consumption, expenditure and aggregate disposable income expressed as C is equal to function of Y. The specific form consumption proposed by Keynes C that by Keynes is C equals to A plus B into Y. Then comes number 96, contractionary fiscal policy. So the government policy designed to restrain level of economic activities of the economy during an inflationary phase by decreasing the aggregate expenditure and aggregate demand to a decrease in all types of government spending and or an increase in taxes. Then comes number 97, contractionary monetary policy. So, type of monetary policy to combat inflation implemented by central banks by decreasing the money supply of an economy and thus making money and credit more costly and less accessible to individuals as well as business. Then comes number 98, copyright, the exclusive legal right of the creator of a literary or artistic work to profit from the work. It is a temporary monopoly like a patent. Then comes number 99, countervailing duties, CVDs. So tariffs imposed on imports to offset artificially lowered price charged by exporters who enjoy export subsidies and concessions offered by the governments in their home countries. Then comes 100, crawling bands. So the value of currency is maintained within certain fluctuation margins, say 1% to 2% plus minus, around a central rate that is adjusted periodically. Then comes crawling peg. So the system under which the par value or exchange rates are changed by very small pre-announced amount at frequent and clearly specific intervals until the equilibrium exchange rate is reached. Then comes 102, credit money. So it's part of total money supply created by commercials by bank. Then 103, credit multiplier. It is also referred to as deposit multiplier or the deposit expansion multiplier. It describes the amount of additional money created by commercial banks through the process of lending the available money it has in excess of the central bank's reserve requirement. Then comes 104, cross rate. So the rate between Y currency and Z currency derived from the given rates of the two pairs of currency, say X and Y and X and Z. So combining both these two. Then comes crowding out. So a decline in one sector spending caused by an increase in some other sector spending. Then comes crowding out effect. So the negative effect fiscal policy may generate when money from the private sector is crowded out to the public sector. Then comes currency appreciation. So a decrease in the domestic currency price of a foreign currency in a floating rate system, which is the same as the increase in the value of one currency. Then comes currency convertibility. So the ability to exchange one nation's currency for another without any restriction or limitation. Then customs union. So a group of countries that eliminates all tariffs on trade among themselves but maintain a common external tariff on trade with countries outside the union. So example could be European Union or EU. Then comes customs valuation agreements. So a WTO agreement that specifies rule for more consistent and reliable custom valuations. It aims to harmonize custom valuation systems on an international basis by eliminating arbitrary valuation systems. Then comes number 111 dead weight loss. So the loss in total surplus that occurs whenever an action or a policy reduces the quantity transacted below the efficient market equilibrium quantity. Then comes deficit in the balance of payment. So the excess of debits over credits in the current and capital accounts or autonomous transaction. Then comes deflation. So a state of sustained decrease in prices and increase in purchasing power of money. Then number 114, demerit goods. So goods which impose significant negative externalities on the society as a whole and therefore believed to be socially undesirable. Then comes desired or planned investments. So the level of investment expenditures that business would like to undertake. Then number 116, devaluation. So a deliberate downward adjustment in the value of country's currency relative to other currency, group of currencies or standard. Then comes number 117, disposable personal income, also known as DI. So it's a measure of the amount of the money in the hand of individuals like us that is available for their consumption or spending, savings. So DI equals to personal income less personal income tax. So the amount that is available after I am paying my taxes is the disposable income that I can dispose of, maybe used for some consumption or for saving. Then comes number 118, Doha round. So the multilateral trade negotiations launched in November 2001 in Doha, Qatar, which was scheduled to be complete in 2004 to address, among the other things, greater trade access by developing countries in developed countries. Then comes number 119, dollarization. So the situation where a nation adopts another nation's currency as its legal tender. Then number 120, domestic content requirements. So it's mandate that a specific fraction of a final good should be produced domestically. Then comes dumping. So the export of a commodity at below its full average cost or at a lower price than the sales price in the domestic market. So it's like a dumping in another country. Then comes duty free zones or free economic zones, FEZ or DFZ. So areas set up to attract foreign investments by allowing raw material and intermediate products duty free. Then comes economic integration. So the commercial policy of discriminatively reducing or eliminating trade barriers only among the nations joining together. Then comes effective exchange rates. So a weighted average of the exchange rate between the domestic currency and the nation's most important trade partners with weights given by the relative importance of the nation's trade with each of these trade partners. Then comes efficiency cost. So also they have written C, dead weight loss. Then embargo. So a total ban imposed by government on import or export of some or all commodities to particular country or religion for a specific or indefinite period. Then comes emission standard. So legal limit on the amount of pollutants that a firm can emit. Then comes number 128, environmental standards. So rules established by a government to protect the environment by specifying possible and prohibited actions. Then comes number 129, escalated tariff structure. So the system wherein the nominal tariff rates on import of manufactured goods are higher than the nominal tariff rates on the intermediate and raw material. That is, the tariff on a product increases as the product moves through the value chain, value added chain, means raw material, then intermediate goods, then finished goods. Then comes European currency quotation. So a direct quote which shows the number of units of a local currency exchangeable for 1 unit of a foreign currency. Example, 1 USD equals to rupees 66.12. So it's a very old rate. Currently it's around 84 to 85. Then comes exchange rates. So the rate at which the currency of one country exchanges for the currency of another country. Then comes explanatory fiscal policy. So policy designed to stimulate the economy during the contraction phase of a business cycle, accomplished by increasing aggregate expenditure and aggregate demand through an increase in all types of government spending and or decrease in taxes. Then comes number 133, expansionary monetary policy. So, monetary policy that raises aggregate demand, real income, and employment. Then comes number 134, expenditure method. It's also called as expenditure approach or income disposable approach. It's a method of estimating national income, measures the aggregate final expenditure in an economy during a specific accounting year, composed of final consumption expenditure, gross domestic capital formation, and net exports. Then comes export subsidies. So the grant of taxes, reliefs, and subsidized inputs to exporters. Then comes export tariffs. So a tax or duty on exports. Then comes number 137, external balance, the state of equilibrium in a nation's balance of payment. Then comes number 138, externalities. So a byproduct of consuming or producing a good that affects someone other than the buyer or seller. These can be external benefits and external costs. Then comes number 139, factor income method, also called as factor payment method or distributed share method, under which national income is calculated by summation of factors income paid out by all production units within a domestic territory of a country as wages and salary, rent, interest and profit. Then comes factor endowment theory. So they are said to refer Heckerschen Olin theory. Then comes factor price equalization theorem. So the part of the HO theory that predicts under highly restrictive assumptions the international trade will bring about equalization in relative and absolute return to homogeneous factors across nations. So this means similar factor, same factor. Then comes fiat money. So money which has no intrinsic value but it is used as a medium of exchange because the government has by law made it a legal tender. A classic example is our currency. 100 rupees note, 500 rupees note, 1000 rupees note, whatever maybe. Then comes number 143, fiscal multiplier. So the response of gross domestic product to an exogenous change in government expenditure. Then comes number 144, fiscal policy. So the use of government spending, taxation and borrowings to influence both the pattern of economic activity and the level of growth of aggregate demand, output and employment. Then comes number 145, fixed exchange rate, also referred to as pegged exchange rate. It is an exchange rate regime under which a country's government announces or decreases what its currency will be worth in terms of either currencies, another country's currency or a basket of currencies or another measure of value that could be gold. Then comes number 146, floating exchange rates. So the flexible exchange rate system under which the exchange rate is always determined by the forces of demand and supply without any government intervention in foreign exchange markets. Then comes foreign direct investment FDI. So it's the process whereby the resident of one country, say a home country, acquires ownership of an asset in another country. Example, the host country. Such movement of capital involves ownership, control, as well as management of the asset in the host country. So a US person investing in Indian assets is a classic example of FDI. Then comes number 148, foreign exchange futures. So it's a forward contract for standardized currency amounts and selected calendar dates traded on the organized market. That is called as exchanges. Then comes number 149, foreign exchange market. So the framework for the exchange of one nation's currency for another. Then comes number 150, foreign exchange options. So it's a contract specifying the right to buy or sell a standard amount of a traded currency at or before a stated date. Then comes number 151, foreign exchange risk. It is also called as open position. So the risk resulting from changes in exchange rate over time and faced by anyone who expects to make or to receive a payment in a foreign currency at a future date. Then comes number 152, foreign portfolio investment. So the flow of financial capital rather than real capital and does not involve manufacturing of goods or provision of service or ownership, management or control of the asset on the part of as an investor, means I doesn't hold the above parts. Then comes number 153, foreign rate, forward rate. So the exchange rate quoted in foreign exchange transactions involving delivery of the foreign exchange on a future date as per the contract agreed upon. Then comes number 154, free rider problem. So a problem that results when individuals who have no incentive to pay for their own consumption of a good takes a free ride on anyone who pays for it. A problem with goods that are not executable, excludable. Then comes number 155, free trade area. So a free trade area is a group of countries that eliminates all trade barriers on trade with each another and retains independence in determining their tariffs with non-members. Example: EFTA, NAFTA, NAFTA, and MERCOSUR or SCORE. So it's a abbreviation. Then comes number 156, General Agreement on Trade in Services, GATS. So a WTO agreement that provides the general obligation regarding trade in service such as most favored nation treatment and transparency. Then comes number 157, global public goods. So public goods which benefit and or cost that potentially extend to all countries, peoples and generations. Now comes number 158, globalization. So the increasing integration of economies around the world, particularly through trade and financial flow, and also through the movement of ideas and people facilitated by the revolution in telecommunication and transportation. Then comes number 159, government failure. So an outcome that occurs when government's intervention is ineffective, causing wastage of resources expended for the intervention, and or when government's intervention in an economy to correct a market failure creates inefficiency and leads to misallocation of resources, of scarce resources. Then comes number 160, gross domestic product, GDP. So the total income earned domestically, including the income earned by foreign owned factors of production, may be expressed at constant prices or at current prices. Then comes number 161, gross national product, GNP. So the total income of all residents of a nation, including the income from factors of production used abroad, that is the total expenditure on the nation's output of goods and services. Then come number 162, hard peg. So a exchange rate policy where the central bank sets a fixed and unchanging value of the exchange rate. Then comes number 163, Heckerschen-Ohlin theorem, HO theorem. So the theory that postulates that a nation will export the commodity intensively in its relative abundance and cheaper factor and import the commodity intensively in its relative scale and expensive factor. Then comes number 164, hedging. So the avoidance of a foreign exchange risk, that is, or the covering of a open position. Then comes number 165, high powered money. So here we have referred that C, reserve money, base money. Then comes number 166, home currency appreciation or foreign currency depreciation. So either it is the one and the same, appreciating the home currency or depreciating the foreign currency. So it takes place when there is a decrease in the home currency prices of foreign currency, or alternatively an increase in the foreign currency prices of foreign currency. So the home currency thus become relatively more valuable. Similarly, we have home currency depreciation or foreign currency appreciation. So it takes place when there is an increase in the home currency price of a foreign currency, or alternatively a decrease in a foreign currency price of a home currency. So the home currency thus become relatively less valuable. Then comes number 168, import quota. So a direct restriction which specifies that only a certain physical amount of the good will be allowed into the country during a specific time of interval, usually 1 year. Then comes number 169, import tariff. So a tax or duty on imports. Then comes number 170, income method. So the national income is calculated by summation of factors income paid out of all production units within the domestic territory of a country, such as wages, salaries, rent, interest and profits. Transfer incomes are excludable. Then comes number 171, inflation targeting. So a monetary policy under which the central bank announces a specific target or target range for the inflation. Then comes number 172, inflation. So a general increase in prices and fall in the value or purchasing power of money. Then comes number 173, intellectual property rights. So the exclusive rights granted to the creators of intellectual property and includes trademarks, copyrights, patent, industrial design rights, etc. Then comes number 174, interbank money market. So a very short term money market which allows financial institutions such as banks to borrow or lend money at interbank rates. Then comes number 175, investment function. So the relationship between investment, expenditures and income. Then we have investment multiplier, also known as K. So the ratio of change in national income denoted as delta Y due to change in investment denoted as delta I. I for investment and Y is denoted for the income part. Then comes Kennedy's round. So the multilateral trade negotiations that were completed in 1967, under which agreement was reached to reduce average tariff duties on industrial products by 35%. Then comes number 178, Keynesian's cross. So a simple model of income determination based on the ideas in Keynes' general theory, which shows how changes in spending can have a multiplier effect on aggregate income. Then comes Keynesian model, so number 179. So a model derived from the ideas of Keynes' general theory, a model based on the assumption that wages and prices do not adjust to clear market and that aggregate demand determines the economic output and employment. Then we have laissez-faire, so the policy of minimum government intervention in or regulation of economic activity advocated by Adam Smith and other classic economists. Then we have number 181, liquidity adjustment facility, LAF. So it's a facility under which the RBI provides financial accommodation to the commercial banks through repos, reverse repos, instituted on the basis of the recommendation of Narasimhan Committee on Banking Sector Reforms. Then we have number 182, local content requirements. So the mandate that a specific fraction of a final good should be produced domestically. Just like recently iPhone started producing their latest phone in the India itself. Then we have 183, that is M1, which is also called as narrow money, is a measure of money supply that is calculated as above, that equals to currency and coins with the people plus demand deposits of bank, that is in current and saving accounts, plus other deposits of the RBI. Then we have M2, which is equals to M1 plus saving deposits with post offices savings banks. Then we have M3, which is also called as broad money, which is calculated by M1 plus net time deposits with the banking system. So it is on a net basis. In M2 we considered saving deposits. In M3 we are considering only net time deposits. And in M4 we calculate, which is calculated as M3 plus total deposits with the post office saving organization, excluding national saving certificates. So it's a standard formulas for that. You may expect some MCQs based on that. Then we have number 187, manage floating exchange rate system. So the policy of intervention in foreign exchange market by monetary authorities to smoothen out short-term fluctuations without attempting to affect the long-run trend in exchange rate. So not impacting the long-run trend, doing some activities which will try to reduce the fluctuations. Then we have number 188, marginal propensity to consume, MPC. So it's the ratio of change in consumption expenditures to change in income, which is denoted as delta C divided by delta Y. Then similar to above, we have marginal propensity to save, that is known as MPS. So the ratio of change in saving to change in income, or delta S divided by delta Y. Then we have number 190, marginal social benefit. So the full benefit provided by another unit of a good, including the benefit to the consumer and any benefit enjoyed by third party. That is the sum of marginal benefit plus marginal extra benefit, marginal private benefit plus marginal external benefit. Then comes to number 191, marginal social cost. So the full cost of producing another unit of a good, including the marginal cost of the producer and any harm caused to the third party. So it's a total of that. So example, that is the sum of marginal cost of production and marginal external cost. Then we have number 192, marginal standing facility, MSF. So it's the facility under which the scheduled commercial bank in India can borrow additional amount of overnight money from the central bank over and above what is available to them through the LAF window by dipping into their statutory liquidity ratio SLR portfolio up to a limit of fixed percent of their net demand and time liability deposits NDTL liable to change at a penal rate of interest. So they can arrange some fund, additional fund based on their SLR and NDTL amount. Then we have number 193, market failure. So it's a market that operates inefficiently and fails to achieve efficient allocation of resources. Then we have number 194, market stabilization scheme, MSS. So under this scheme, the government of India borrows from the RBI, such borrowing being additional to its normal borrowing requirement, and issues treasury bills, dated securities for absorbing excess liquidity from the market arising from large capital inflow, means coming money into India. Then we have number 195, mercantilism. So the body of thought that postulated that the way for a nation to become richer was to restrict import and stimulate export. Thus, one nation could gain only at the expense of another nation. Then we have MERCOSUR, MERCOSUR. So the South American Common Market that was formed by Argentina, Brazil, Paraguay and Uruguay in 1991. Then we have number 197, merit goods. So goods which are socially desirable and have sustainable positive externalities. They are rival, excludable, limited in supply, rejectable by those unwilling to pay, and involves positive marginal cost for supplying to extra user. Examples: education, healthcare. We have then number 198, minimum support price. You may have heard it in the news also. Minimum support price, MSP. So it's a guaranteed minimum price as well as procurement by government agency at the set support prices to ensure steady and assured incomes to producers. Then comes number 199, mixed tariff. So it's a combination of a ad valorem and a specific tariff. Then we have number 200, monetary base. So the supply of currency and bank reserves, also called as high powered money. Then we comes to number 201 Monetary Policy Committee MPC. So an empowered six-member panel of experts in India to determine through debate and majority vote the benchmark policy interest rate repo rate required to achieve the inflation target. Then we have number 202 Monetary Policy Department MPD. So it assists the MPC in formulating the monetary policy. Then we have number 203 Monetary Policy Framework Agreement. So an agreement reached between the Government of India and the RBI Reserve Bank of India on the maximum tolerable inflation rate that the RBI should target to achieve price stability. Then we have number 1204 Monetary Policy Instrument. So the various direct and indirect instruments that a central bank can use to influence money market and credit condition and pursue its monetary policy objective. Then we have number 205 monetary policy. So the use of monetary policy instruments which are at a disposable of the central bank to regulate the availability, cost and use of money and credit so as to promote goals of government's economic policy. Then we have number 206 monetary transmission mechanism. So the process or channels through which the evolution of monetary aggregate affects real variables such as aggregate output and employment. Then we have number 207 monetary union. So a group of economies that have decided to share a common currency and thus a common monetary policy. Then we have number 208 money demand function. So a function showing the determinant of demand for real money balance. Then comes number 209 money multiplier. So the ratio that relates the change in money supply to a given change in a monetary base. Example, what multiple of the monetary base is transformed into money supply. Then we have money supply. So the amount of money in an economy available to the public like us at any point of time, usually determined by the central bank and the banking system. Then comes number 211 money. So assets which are commonly used and accepted as a means of payment or as a medium of exchange or of transforming purchasing power. Then we have number 212 moral hazard. So the situation that can exist when someone is protected from paying the full cost of their harmful actions and act irresponsibly, making the harmful consequences more likely. Then we have most favored nation. So the extension of to all trade partners of any reciprocal tariff reduction negotiated by a WTO member with any other nation. Then multilateral trade negotiations. So trade negotiations among many nations, multilateral, multiple parties. We have then multiplier, the ratio of the change in income to change in investment in a closed economy. That is number 215. Then comes number 216 narrow money. So the sum of currency held by the public, demand deposits of the bank and other deposit of RBI. Then comes number 217 national income equilibrium. So the level of income at which the desired or planned expenditure equals the value of output and desired saving equals desired investment. Then we have net exports, the difference between a country's total value of export and total value of import. Then comes net factor income from abroad, NFI. So the difference between the total factor income received from abroad and the total income factor paid to abroad. Then we have number 220 net indirect taxes, that is indirect taxes less subsidies paid. We have then nominal exchange rate. So the exchange rate at which one country's currency trades for another country's currency. Then comes number 222 nominal GDP. So it is gross domestic product GDP evaluated at current market prices and is not inflation adjusted. Therefore, nominal value of GDP for different type rates can differ due to change in quantity of goods and service and or change in price levels. Then comes nominal tariff, such as ad valorem 1, calculated on the price of final commodity. Then we have non-tariff measures, so policy measures for restricting trade other than ordinary custom tariffs that can potentially have an economic effect on international trade in goods, changing quantities traded or price or both. Then comes non-exportable goods. So goods in the case of which the supplier cannot prevent those who do not pay from consuming the goods. Then we have not profit non-profit institutions serving households. So non-profit institutions which provide goods or service to household for free or at a price that are not economically significant, means a little bit wide. Example includes churches and religious society, sports and other clubs, trade unions and political parties. Then we have non-rival goods, the same unit of goods that can be consumed by more than one person at the same time. Then comes North American Free Trade Agreements, NAFTA. So the agreement to establish a free trade area among the United States, US, Canada and Mexico that came into existence on January 1st, 1994. Then we have number 229, open market operations, OMO. So a general term used for market operations conducted by the RBI by way of sale or purchase of government securities to or from the market with an objective to adjust the rupee liquidity conditions in the market on a durable basis. Then comes opportunity cost. So the value of the next high valued alternative used of that resource that is given up when a decision is made. So suppose a decision is made to do a X activity, and in case we doesn't do the X, we can consider doing Y. So opportunity cost is the loss we bear by choosing X over Y. Then we have number 231, over the counter market. It's also called as OTC market. So it's a decentralized market with a central physical location where market participants trade with one another through various communication modes. Then we have own account production. So it's the production performed by a business or government for its own use. Then comes per capita income. So income per head, that is the total national income divided by the total population. Then we have personal income, that's a measure of the actual current income received of person from all the sources. Then comes number 235, Pygovian taxes. Named after AC Pygo, is a tax on pollution. These taxes, by making the polluter pay, seeks to internalize external cost into the price of a product or activity. Then we have number 236, plurilateral trade agreement. So four agreements originally negotiated in the Tokyo round, which have a narrower ground of signatories. Then comes number 237, policy rate. So in India, the fixed repo rate quoted for sovereign securities in the overnight segment of LAF is considered as a policy rate. Then we have number 238, precautionary motive. So it's a desire to hold cash in order to be able to deal effectively with unforeseen, unexpected contingencies that require cash outlay. Then comes number 239, preferential tariff. So a tariff system under which the parties levy lower rate of duties on import from one another than they do on import from third country. Then comes price ceiling. So when prices of a certain essential commodities rise aggressively or excessively, then government may restore to control in the form of price ceilings, also called as the maximum price, for making a resource or commodity available to all at reasonable prices. Then comes number 241, price intervention. So, intervention by governments to influence the outcome of a market generally takes the form of a price control, which may be either a floor price, that's a minimum price that is required to pay, or a price ceiling, that's the maximum price that a seller are allowed to charge for a good or service. Then comes private cost. So, a producer's or supplier cost for providing goods or services. These do not always equate with the total cost to the society. Then we have private goods. So, a good that is both excludable and rival in consumption. Then we have product method, also known as value added method or industrial origin method or net output method. It's a method of measuring national income that entitles the aggregation of production of each industry less intermediate purchase from all other industries. Then we have number 245, progressive tax. So it is a tax in which the tax rates increases as the taxable income increases. So India has a progressive tax system. Then comes prohibitive tariff. So it's a tariff sufficiently high to stop all international trade. Then we have public borrowings, that is borrowings by government. Then we have number 248, public goods. So non-exclusive and non-rival goods, the marginal cost of provision to an additional consumer is zero and people cannot be excluded from consuming it. Then we have a term called pump priming. So when private spending becomes deficient, certain volumes of public spending will help revive the economy. Then we have number 250, pure private goods, a good that is both rivalrous and excludable. Similarly, we have, I think there are some numerical error after 250, it's directly 256. We have pure public goods, so a good that is both non-rival and non-excludable. Then we have quantitative restriction, QRs. So it's a trade restrictions, also called as trade quota, which places limit on the volume or value of a good or service that can be improved into the country, frequently resort to for protecting the price of domestically produced goods or to decrease or eliminate a trade deficit. Then we have number 259, quasi public goods, also called near public goods. It purchases nearly all of the qualities of private goods and some of the benefits of public goods. It is easy to keep people away from them by charging a fee or price. A classic example is education and healthcare service. Then we have real effective exchange rate, REER here. So the nominal effective exchange rate, a measure of the value of a currency against a weighted average of several foreign currencies, means a price with weightage average from all the major currencies divided by a price defector or index of cost. Then we have number 261, real exchange rate, that is equals to nominal exchange rate into domestic price index divided by foreign price index. Then comes number 262, real GDP. So it's a national inflation adjusted measure that reflects the value of all goods and services produced by an economy in the given year expressed in base year prices and is often referred to as GDP at constant prices or inflation corrected GDP. So all the three are the one and the same. Then we have a word called recession. So it's a stage of contraction in a business cycle which results in a general slowdown in the overall economic activity. Then we have recessionary gap, also known as contractionary gap, is said to exist if the existing level of aggregate production is less than what would be produced with full employment of resources. Then we have number 265, redistribution function. So it's the state function to ensure equity and fairness to promote the well-being of all sections of people and achieved through taxation, public expenditure, regulation and preferential treatment of target population. Then we have number 266, regional trade agreements, RTAs. It's the grouping of countries not necessarily belong to the same geographical area which are formed with the objective of reducing trade barriers to trade among the member countries. Then we have number 267, repos, also called as repurchase options, or repo is an instrument for borrowing funds by selling securities with the agreement to repurchase the securities on a mutual agreed future date at a agreed price, which includes interest for the fund borrowed. So it's a money market instrument which enables collateralization, short-term borrowings, and lending through sale or purchase operations in debt instruments. Then we have number 268, reserve money. So reserve money is comprised of currency held by the public, cash reserve of banks, and other deposits of RBI. Then we have reverse repo. So it's an instrument for lending funds by purchasing securities with the agreement to resell the securities on a mutually agreed future date and at an agreed price, which includes interest on for the funds lent. Then we have number 270, rivalrous. So it is referring to a goods describes the case in which one unit cannot be consumed by more than one person at the same time. Then we have rules of origin, that is are the criteria used by governments of importing countries to determine the national source of a product. So their importance is derived from the fact that duties and restrictions in several cases depends upon the country of origin of import. Then we have safeguard measures. So measures initiated by countries to restrict import of a product temporarily if its domestic industry is injured or threatened with serious injury caused by a surge in import. Then we have sanitary and phytosanitary measures, SPS. So measures provided for in WTO agreement which can be applied to protect human, animal or plant life from risk arising from additive, pest, contaminants, toxins or disease causing organisms and to protect biodiversity. Then we have saving function. So the relationship between saving and income. In general, saving is negative when income is zero and rises as income rises. So in such a way that the increase in consumption plus the increase in saving equals to total income. So it's an equation. Then we have number 275, social cost. So the total cost to the society on account of production or consumption activity. Social costs are private costs borne by individuals directly involved in the transaction together with external cost borne by third parties not directly involved in the transaction. So the formula is social cost equals to private cost plus external cost. Then we have number 276, soft peg. So it's an exchange rate policy under which the exchange rate is generally determined by the market, but in case the exchange rate tends to be more speedily in one direction, the central bank will intervene in the market. Then we have number 277, SDRs, special drawing rights. So international reserve created by the IMF to supplement other international reserves and distribute to member nations according to their quotas in the fund. Then we have 278, specific tariff. So it's an import duty that assigns a fixed sum per unit of the unit imported. Then we have number 279, speculative motive. So people's desire to hold cash in order to be equipped to exploit any extraction investment opportunity requiring cash expenditure. Then we have number 280, spot exchange rates. So the exchange rate in foreign exchange transaction which are carried out in the spot market and the exchange involves immediate delivery. Then we are almost to the end of this video. We have only few more left. Then we comes the 281, stabilization function. It's the one of the key function of fiscal policy which aims to eliminate macroeconomic fluctuations arising from suboptimal allocation. Then comes number 282, stabilization policy. So public policy aimed at reducing the severity of short-run economic fluctuations. Then we have stagflations. So it's the combination of recession or stagnation and increasing prices or inflation. Then we have number 284, statutory liquidity ratio SLRs. It's a stipulated percentage of the total demand and time liabilities, that is DTL and NDTL, of a scheduled commercial bank in India, which is required to maintain with RBI in cash, gold, or approved investment in securities. Then we have number 285, supply of money. So the nation's total money supply, which is equal to the nation's monetary base times the money multiplier. Then we have tariff rate quotas, TRQs. It's a combined two policy instruments, namely quotas and tariff. So imports entering under a specific quota portion are usually subject to a lower, sometimes zero tariff rate, while imports above the quantity thresholds of the quota faces a higher tariff. Then we have tariffs, also known as custom duties, are taxes or duties imposed on goods and services which are either imported or exported. Then we have number 288, theory of liquidity preference. So a simple model of the interest rate based on the ideas in Keynes' general theory, which says that the interest rate adjustment to equilibrate the supply and demand for real money balance. Then comes tradable emissions permit. So the system of marketable permits allocated among firms to eliminate limited quantities of pollutants which can be bought and sold by polluters. The high polluter have to buy more permits and the low polluters receive extra revenue from selling their surplus permits. Then we have number 290, trade policy. So the regulations governing a nation's commerce or trade and encompass all instruments that government may use to promote or restrict imports and exports. Then we have trade related aspects of intellectual property rights, that is IPR. So in short, the all is called TRIPS. So it's a WTO agreement that stipulates more favored nation treatment and national treatment for intellectual properties such as copyright, trademark, geographical indication, industrial design, patents, etc. Then we have number 292, trading bloc. So it's a group of countries that have free trade agreement among themselves and may apply a common external tariff to other countries. Then we have tragedy of the commons. So the problem of overuse when a good is rivalrous but non-excludable. Then we have number 294, transaction demand for money. So the demand for active money balances to carry on business transaction. It varies directly with the level of national income and the volume of transaction. Then we have transfer payments. Any payment from the government to individuals that are not in exchange of goods or service. Example, social security payment. Then we have trigger price mechanism. So the quick response of affected importing countries upon confirmation of trade distortion to offset the distortion. Then we have number 297, unilateral transfers. These are one-way economic transactions between the resident of two nations over a stipulated period of time. This includes gifts, donations, personal remittance, and other one-way transactions. Then we have Uruguay round, that is the multilateral trade negotiations between 1986 to 1994, the last and the most consequential of all round, culminated in the birth of WTO and a new set of agreements replacing the GATT, that is General Agreement on Tariff and Trade. Then we have value added, that is the value of a firm's output minus the value of the intermediate goods purchased, firm purchased. Then we have the number 300 value added approach. So it's a measuring GDP by summing of the values added by all firms in the economy. Then we have number 301 vehicle currency. So a currency such as US dollars used to denominate international contracts and for international transactions. Then we have number 302 voluntary export restraints VER. So it's a type of informal quota administered by exporting countries voluntarily restricting the quantity of goods that can be exported out of a country during a specific time of period. Then we have number 303 World Trade Organization WTO. So it's the organization set up at the Uruguay round with the objective of facilitating the flow of international transactions smoothly, freely, fairly, and predictably. It has authority over trade in international goods, agricultural commodities, and services, and to settle the trade dispute. So that's it in this video. Thank you for watching. Keep learning, keep growing, and keep rocking.